From the makers of the first talk, there's another one. It wasn't on their original schedule. You can check the reserve site right now. In fact, let me get the mouse over here. We will. All right, we got a cracking setup over here. Oh my goodness. You think just 60 seconds, is that what it's gonna be? He talked for about another 3 minutes later on before another panel. So that's what leads me to believe, and he's been in the crowd for the entire day. It's what leads me to believe that if he's still there, I'm gonna get this light on real quick. I just went ahead and shift on the live. I'm gonna cut this part out when we actually post it. So if you're here, welcome, you're early. I'm gonna cut this part out of the final. Can you give me a quick vote if you're in the chat real quick? Can I just get a quick, real fast synopsis? Got two hats. Which one do you think rocks with the fit right now? Do we pick we got the bucket, it's number one, and then we got forward or backward, just standard as it goes. I also gotta put on I'm gonna say go to the backward. I heard the key letter, no. Then bucket it shall be. Setup is putrid. Setup is putrid. Y'all are the people. Appreciate you. Sound coming in okay. I have the desktop up a little louder. Because last time Powell was a little quiet. So music might be a little overpowering though. Bucket hat baby. Andrew baby. Got the bucket hat baby. Time for the Federal Reserve to tell us about something. Just not a little intro and then dip. There's not going to be a cut. Heard it here first. There's just not going to be a cut for statistical, historical reasons. We don't have sub 5% employment of the U3. That is the main item that is tracked. And we don't have inflation that's below 2%. That's where we were at or aiming for when we did the original September cut in 2024, the subsequent one after, and then the last one in December. But all the while, the 10-year treasury rate was going up. So they have the bond market to worry about. They have inflationary pressures from inflation, in tariff inflation, especially the goods economy. Good Lord. Housing's up 4%. Utilities, electric, 6.8% just since last year. They're in a conundrum like no other, not to mention the social pressure. The Federal Reserve is currently being investigated for the $1.9 billion budgeted Federal Reserve renovation spreading across to 2.5. Jerome can't go a day without Trump mentioning him in a cabinet meeting or a one-on-one with a president in the Oval Office, or sketching strays as he's getting on the helicopters, calling him a moron. Like, there's a lot of pressure. But as somebody who watches Jerome and has now for 5 years, it's our 5-year anniversary, Jerome, every meeting, perfect attendance, nobody has attended more than I. The one thing I'm most certain of, he's not resigning. He's not bowing to the presidential authority, no matter whom. Doesn't matter bipartisan. He sticks to the numbers. He sticks to the numbers. Now, the big issue is the numbers might also be shitty. They even talked about this at a recent hearing, that we may actually be looking at numbers that are indeed lagged and are indeed being archaically tallied via phone calls and surveys. We need better ways to accumulate what we're looking at as the CPI index and the numbers within it, the microdata of each and every category. We need to also maybe look at how we're gaining the data on the unemployment side, because if someone's working a gig economy job like DoorDash and delivering one DoorDash a weekend, they're employed. And if you quit looking for a job for 4 weeks, you're not even counted as unemployed anymore. You're super unemployed. You're not counted as unemployed. The way that we track what's good and bad in this economy is kind of janky, in my opinion. You look at GDP, that includes industrial war spend. What the hell's up with that? You paying your health insurance bill 80 grand because you broke your leg is part of GDP. What the hell is up with that? Credit card loan payment back, that's part of GDP. All of it is. So it's a whitewash way of looking at our economy. So everywhere I look, the way we track it, it's like, it's all good. Stock market's great. Okay, top 7 companies on it are making the majority of the money for the S&P 500. Come on, Meta, Tesla, Google, all of them. They're the ones creating the actual profit for the entirety of the consumer spend that's coming in, that's getting dwindled since COVID. Savings rates are at all-time lows. Home prices are 47+%. What is Jerome to do? You imagine just thinking about this all night? He's sitting like, I can't imagine he gets a good wink of sleep. The reason Donald Trump wants lower rates is 2 reasons. One that is factual and one that is purely hypothetical that I quite frankly don't believe would actually happen. Number 1 reason he wants to lower rates is to refinance the debt of our bond market. Our bond market is how our country and others, we're not esoteric to this, package our debt together and sell it off. It's like a commoditized mortgage obligation, a CMO, or RMBS, a residential mortgage-backed security, where it's a bunch of debt packaged together. And we sell it to investors for a yield. The yield is what we look at. And the yield sits right now at like that 5% range for like a 10-year yield. The 10-year yield is an investment that the investor has to put their money out for 10 years. They're loaning to the government for 10 years. So the one thing you want as the investor is to know that your 10-year investment is going to beat inflation. So when we start doing inflationary things, we start pushing this rate up. So here's why I think what the other thing Trump wants to do, which is lower mortgage rates for people like you and I, is he's coming at it from the wrong place. He's going to try to lower the Fed rate by 1%, 2%, 3% nearly immediately, and that is going to cause chaos and uncertainty in the market. Look out for this. That happens if a resignation were to happen, if a firing were to happen, if he puts in a yes man like Scott Bessent, there's going to be uncertainty, and just like what would happen in December 2024 when we cut rates, theoretically speaking, this already happened. We saw the Fed rate cut 3 times, and what happened to mortgage rates? They went up. One of the first times that those two detethered from one another. That's not normal. The Fed's assessment of by the Fed rate is normally the baseline for which investors see our economy. Maybe that tether is breaking. It's big stuff. It's a lot to handle. Are we here? Nope. Music switched up on me. I got confused. I cannot lie. I got confused. My computer isn't sending the signal to the, I can't see your comments. Oh, just like that, we're back. And that's a great one we didn't mention, the quantitative easing. That was something that was influenced by the consultation of BlackRock in 2008 that never existed prior to. And let's talk about how quantitative easing has exactly to do with what Wally is saying. Quantitative easing is not money printing. It ends up adding money to our monetary baseline. The M2 supply is going to go up. There's more money in the economy. But the reason there's more money in the economy is because it flows to investment account holders of debt. Hear me. Quantitative easing started in 2008. Why? Because the bond market was freaking out. We needed to lower mortgage rates. We needed to lower the ability, the gate for people to be able to jump over to get into acquiring credit because we are a debt economy. We needed to get people to get back into debt because everyone was broke. Everyone was foreclosing. Banks were getting bailouts, but everyone was foreclosing. And so the bond market was suffering. So what did the Fed do? They came in and bought some. They bought up large portions of the bond markets when they went to auction to push the price down, to provide demand that suppressed price increase and actually decreased it to the point where they could start restabilizing the economy and we start to see that melt up. They did that 4 different times. They don't do that for fun. That's like last ditch. It was brand new. They interfered with the free market. There weren't enough buyers to support that low of a rate. And that's why we had such low rates, such easy money since then. Guys, we're adding cards to a house of cards, and it's getting windy. It's getting windy is all I'm saying. I'm seeing cracks when I'm driving down the road in people's windshields. I'm seeing donuts on cars. It look like they've been on there more than 10 miles. They're 10, 20 miles. I think there's a minimum on those, maximum on those. I'm seeing people at the grocery store looking just as confounded at the cash register teller who's like, it's $375, sir. Like, what? We're walking off the lot, according to Experian, for $350 a month on a median? What? And all that to say, the theory that if he were to resign or even fire Powell or have him tried for something and then get somebody put in place would send shivers through the market. People would not want to hold bonds. Japan, being one of the biggest E7 countries in the world, holding almost all of our, the most. They don't beat us. We're first, we hold the most, but investors get that money, 401ks get that money, IRAs, Roth IRAs get that money, TSPs get that money, funds and trusts get that money. That's not money that's flowing directly into consumer spend via the bottom 50%. It's all happening in the top 10%, and that's why the economy looks different than it feels. We have so many people in the top 10 supporting the rest of the 50% with the consumer spend, with the higher employment, and by golly, inflation might just have to stay at this 2 to 3% level, and you're going to continue and continue and continue and continue to be priced out of the housing market, all while rates don't come down. And that's terrifying. That's a wealth gap growth. That's a wealth transfer. Let me see. Powell right now. No, nothing I'm seeing. Trump says Powell will be out in 8 months. That is when his term ends. I'm scrolling through right now. We're up to date. Yesterday morning, Bessett called for an internal review of the entire Fed. Fortune says Powell should resign, according to top economist Mohammed El-Ryan. Powell under siege as the Fed conference kicks off. Nothing saying he has officially do anything. Actually, the most recent is Powell has been noted in Trump's latest interview. He was talking with the president of Singapore today. I was watching some of that. Very interesting. I have some screen recordings I'm going to share on TikTok because I was like, wow, that was your answer to that question? It looks like he said Powell is probably going to serve out the rest of his term as federal chair. So I don't think there's anything credible to his resignation right now. And again, if I'm sitting on the roulette table of what's going to happen next, I don't know why I haven't been doing this the whole time. Let me fix the zoom real quick. Zoom and the focus are off. I still can't see some of my so jacked. There we go. Now I can see my toes when I walk by. Whoop! Watch the toes. Oh, never mind. We're over here. It's a fake memo. Dude, it's tough these days, man. It's so tough. Whoa, did I accidentally exit out? Oh, no. Let's get back in there. Let's get back in there. Thank you. All right. Man, I hate that for you, brother. Yeah, let me see why I can't see. I can't see all the comments. So if I'm ignoring you, I really apologize. I'm not trying to. Excellent. Okay. There we go. Now we're in here. Andrew, free the dogs. I am. Can I tell y'all a secret? I haven't posted about this anywhere. About 10 of us in here. What's going on? Can I share a little secret? You can't judge me. I love golf. I'll start with that. I love golf. I'm not very good. I'm getting better. I will give myself some credit. I believe I am indeed getting better, but not great. All that to say, I love golfing barefoot. I absolutely love it. It's one of my favorite. It's become one of my favorite things to do. I'm just going to put it out there. Think about it for a second. What better place to walk barefoot than when they take care of everything on the facility? They're literally taking care of everything for you to walk on. The greens are beautiful. The fairway is nice. Rough. You get in the sand. When you walk into the bunker, it's like nice and warm on your toes. The greens, it's like you're on the beach. You feel a little bit more connected. It forces me also not to come over the top of my swing. I get too over the top and that slices it. Don't want that. It's not diabolical. I'm connected with the earth. It's called grounding. There's science to it. Andrew Huberman said it, so I believe it. Target, brother. Target. Target has finds sometimes. I'll tell you what, they got an area with cool shirts. I wish they had more button-ups. It's a movement. I'm trying to Squippy Opie Hoppy. I can't remember. I can't see your name. Squippio Opio. Would it make sense at all to hold savings in non-dollar assets, gold, mutual funds, presupposing it's not financial funds? It's not financial advice at all for entertainment purposes only. I am about 60-40, and I'll tell you what the 60-40 is in, and then I have two other assets, okay? The two other assets are I run a real estate team, and that team is generating income based off of leads I'm able to supply that they are able to close. And in a low lead market, it's great to get great organic leads that really want to work with us, that really want to be served, and we deliver on a high level. That's an asset. The other one is my home. I've owned this home since September of 2020. I bought it for $263. Last home I bought before this, I bought for $164, sold for $250, and then moved into this house a year after. And now the home is worth $400K. So I have about $167,000 in equity in this. And then I said 40-60. That's my investment portfolio. I'm about 40% in what's deemed safe. Spider, the S&P 500, mutual fund stocks, things like that. But I have 60% of my allocation into what I consider risky. And right now I'm knee deep in XRP. It's the majority of that 60%. But I love a good 60-40. Difference right there. 60% being more on the risky, 40% being more on the more traditional. It used to be the other way around for a lot of people, but I think there's a lot of people who are moving into silver as a leading indicator of detethering from the dollar and the dollar's strength itself against the euro. Okay, we'll shut up.
Who's left is Kate Judge, who's a law professor at Columbia Law School.
Gosh, why don't they whisper?
Superstar financial regulatory professors in America. Very sensible, very persuasive. Great to have her on the panel. Next to her is John McDonald, who's on a sell-side research analyst covering the banking sector at Truist. He's going to give us a perspective of investors on stress testing as much as possible, as opposed to that of the banks. And then Till Sherman at the end of the row there is a global head of finance and risk at Oliver Wyman. He's also really important for this panel. He was one of the designers of the Supervisory Capital Adequacy Program, or SCAP, in the aftermath of the financial crisis, which was really important, probably why we have stress testing, at least in the U.S. today, because it was so successful. What we're going to talk about are sort of the key policy issues. Some of the policy issues that need to be decided by the Fed in the short term on stress testing. I'm going to try to leave time at the end for questions. It will be sort of an interactive panel.
Great. Questions.
I also know that there are a lot of journalists, public policymakers, and other people in the room and on the video feed that may not be stress testing experts. So I'm going
we do have Federal Reserve Board members up there. The man speaking right now is on the board. So we at least have that.
More on this panel than you did on the other ones. So just real quickly, this is very basic. The U.S. capital requirements are obviously based on the Basel Capital Framework, which, as Randy Quarles mentioned, the Federal Reserve had an important role in designing. And the Basel Capital Framework has three pillars, which is actually important to understand for purposes of understanding the discussion that we'll have on this panel. So Pillar 1 defines each firm's minimum capital requirements. The most important minimum capital requirement for our purposes today is the Common Equity Tier 1 risk-based capital ratio. It consists of a minimum CET1
not Jerome Powell,
capital ratio of 4.5% plus a capital conservation buffer
on YouTube if you want to join us. I'll put the link below.
And the largest banks known as global. We've talked about this. Obviously, they have the GSIB surcharge as well, which ranges currently from 1
What's
to
up, Zach?
4.5% in the United States. Pillar 2, and this is going to be important, the difference between Pillar 1 and Pillar 2. Pillar 2 is the highly discretionary supervisory review process, and then Pillar 3 are public disclosure requirements.
I didn't catch the second
So
one.
stress tests are designed to determine whether the minimum capital requirements of the largest U.S. banks would be sufficient to weather a severely adverse macroeconomic scenario and still be able to function as viable banking entities. Is the second part that surprised me when they first came out. I thought the point of stress testing is to make sure they had enough capital to survive, but in fact, we've had a higher standard, and I think in retrospect, that was the right choice. During the period of great uncertainty, the Federal Reserve performs what is called a supervisory stress test, and then the banks perform their own company-run stress test. And the first supervisory stress test in the U.S. was performed during the aftershocks of the 2008 financial crisis, and it was called the Supervisory Capital Assessment Program, or SCAP. During that period of great uncertainty, the stress test was used to provide an independent assessment of the capital adequacy of the U.S. banks, and that actually had a big calming influence on the market at the time. Coming out of the global financial crisis, the Dodd-Frank Act established an ongoing role for stress testing. It requires the Federal Reserve to conduct an annual supervisory stress test known as DFAST. It also requires us to disclose the key results of these annual tests, including projected losses, net revenues, and resulting capital ratios for each bank. Until 2020, the Federal Reserve also used the DFAST to evaluate the capital adequacy of the largest U.S. banks in a process called the Comprehensive Capital Adequacy and Review, or CCAR. CCAR originally had two components, a qualitative assessment and a quantitative assessment.
It's giving us a history lesson right now.
The Federal Reserve could object to a firm's capital plan because of deficiencies in either the qualitative or quantitative
We'll see if he gets it
component.
today.
Since
I'm here for the
2020,
questions.
The supervisory stress test has been used to replace the capital conservation buffer. Remember, I mentioned that was 2.5%, with a variable buffer known as the stress capital buffer, or SCB. The SCB eliminated, or this new regulation eliminated the qualitative assessment, which got into the normal governance and control supervisory process. And that meant that the CCAR ceased to be a pass-fail exercise, which it had been up until that point.
Snorefest.
The SCB can be more than 2.5%, but it cannot be less. The SCB is the only buffer that non-GSIB banks are subject to, and the GSIBs, of course, also have the GSIB surcharge. In 2023, the Federal Reserve started using exploratory stress scenarios. The exploratory scenarios were designed to provide additional information about risks that are not typically captured in the stress test, but without actually affecting the capital requirements. Mainly because of difficulties in projecting trading losses and net revenues, and honestly, because of weaknesses in the Federal Reserve's supervisory stress test and stress models, the results of its annual stress tests have been quite volatile from year to year. The Federal Reserve has tried to address this volatility in two ways. First, by additional transparency about the models that would allow the banks, academics, and broader public to help the Federal Reserve identify and fix flaws in its model. And second, and most recently, we proposed a regulation to average the results of the stress test over a 2-year period to reduce the amount of volatility. So with that background, I'm now going to turn to the questions on the panel.
Here we go.
And then kind of elaborate on what we've seen in terms of volatility. So that if you've looked at the 2025 DFAST results, which just came out, they showed an aggregate drop of 1.8 percentage points in the CET1 capital ratio compared to an aggregate drop of 2.8 percentage points in the 2024 DFAST results, which is a pretty big variation. That volatility is partly explained by the scenarios, which turned out to be less severe in 2025 than they actually were in 2024. But part of the volatility is attributable to flaws in the supervisory models. Now, in 2019, you'll see where I come on this. I gave a speech at a Federal Reserve internal conference on stress testing, where I think it was entitled making the case for full transparency in models, scenarios, and outcomes of the supervisory stress test.
Nerd.
The principal justification, at least in my speech, for full transparency is that it allows the banks, academics, and the public to help the Federal Reserve identify and correct flaws in the supervisory models. The principal argument against full transparency has typically been that it's like giving students the answers to an exam in advance, allowing banks to game the stress test. Okay, so Till, let me start with you. So with that, introduction, what's the best way for the Fed to address the problems of flaws and volatility in its supervisory models? More transparency, averaging, adjustments to assumptions, or something else?
Thanks, Randy. Thanks for the introduction. Thank you also to Governor Bowman and the Fed for putting on this amazing conference. It's really been a tremendous discussion already today. So of the three elements of the capital framework that you described, stress testing is by far the most model dependent. So it's right for us to spend a lot of energy, a lot of time looking at models and whether or not those models are in fact robust. Models, of course, are not reality. They're a representation of reality, and the representation of reality that gets more and more complex. So I have sympathy with what Mike Mayo articulated earlier today, which is, I want something simple, but I want something strong. Part of the framework that we have is simple, but there has to be a place where the complexities and the increasing complexities of our world can be in some way represented and addressed. So these models.
Oh. Oh.
Have, therefore, limitations. The supervisory models have limitations, and the bank models have limitations. More transparency will help some, but I think we're kidding ourselves if we think that more transparency is going to result in perfect models. What I'm most concerned about actually is that the models will become sclerotic, that the models are not going to adapt sufficiently well and sufficiently quickly to the changing environment, but also to changing risk-taking by banks. I don't know if transparency will either make them more or less sclerotic, but for sure, that's one of the things that we need to worry about. So if the public puts a stronger eye on those models, if it helps to mitigate against this risk of them becoming static.
I think I'm beginning to realize that the questions he alluded to earlier
they are
questions that he is going to ask of the panel,
of volatility in the stress capital buffer.
Not of the reporters of the panel.
Are changes in scenarios, which you mentioned, but there's one more,
what I
and
was
that's the
hoping
change
for.
in bank portfolios and the business mix that banks have. I think the latter two actually are the biggest drivers. I don't think that changes in models or so-called imperfections of models, recognizing.
I don't know how I feel about being
these models are
bamboozled
gonna be
twice in a
imperfect,
day.
are really the biggest drivers. It's the changes in scenarios and the changes in
On hell,
portfolios.
I'm here, my friend.
That leaves us with a question then, okay, what do we do about this volatility? On the one hand, the volatility might just reflect the realities of life, that the risks are changing. And that's one of the real strengths of stress testing. It dynamically evolves to adapt to those risks. But it also makes, as was clear in some of the earlier discussion today, it makes capital planning really hard, and I have a lot of sympathy for that. So then we come to well, what do you do? One of the proposals that has come out is to average across 2 years. You've got one scenario, you've got a number. This year, you have a number last year, you take the average of the two. I would candidly rather than average one scenario across 2 years, I'd rather average 2 or 3 scenarios in any given year in this year to really capture a much broader sort of scope of risks. Now, for those of you who have been doing stress testing for a living at banks, this is an enormous burden to actually crank the machine, write down all the documentation, do all the review and challenge. And the burden has really sort of gotten, frankly, out of hand. So I would, in that sense, like to see a reduction in that documentation burden, that governance burden. And then perhaps in exchange, we can get more than one scenario in any given year and take the average of those rather than just one scenario over 2 years.
Thanks a lot, Till. That's great. So, Kate, what would you choose? More transparency, averaging, revised assumptions, or something else? And sort of to the extent you can, why or why not?
Yeah, I mean, I think building directly after Till, I would separate out the two different issues. I think averaging is meant to deal with a number of challenges. To the extent the challenge is the model is broken, we should fix the model. We shouldn't use averaging to try to correct
Poll
the error of the
incoming.
model.
As soon as I can see
That
my
being
screen
said,
again.
has already come up
Blinked out
much
on me.
today. It is more challenging for banks to try to figure out capital planning when there is significant volatility from year to year. You want scenarios to be different. You want to be testing for different things from year to year. And so you don't want, in an effort to make sure we don't have too much volatility, you're actually shying away, and I think we've seen this, from testing out different types of risks. And so in that sense, I think averaging can serve a very positive purpose apart from the model. In terms of transparency, I think a lot of the question is, transparency to what end? And is it helping to support the rigor and the efficacy of the test, or is it potentially undermining it? I happened to get like an email from Gallup this morning, and one of the first headlines was like, trust in institutions is just at an all-time low in the United States, right? So like banks, it's between 20-something and 30-something%, depending on who you're looking at. But basically, if you look from like the 1970s to today, you have this very clear downward secular trend in terms of trust in institutions. And I think a lot of government rightfully thinks about, well, we're going to build up trust by promoting transparency. And I think there is a greater burden on the government to be transparent and have that be a mechanism through which you promote accountability. But I think ultimately the way that you build up trust is you do your job and you do your job well. So I think the key question here is this going to help enhance or undermine the efficacy? The best thing we know historically, I was walking with Scott Frame on the way in here, and he did a tremendous paper back when I think he was still at the Fed, looking at OFEO. So, I mean, stress tests started for the banks in 2009 with Till and others with this great effort. Fannie and Freddie were earlier to it. OFEO was earlier to it. They realized stress testing is going to be incredibly useful. And they said, look, we want full transparency. We want to make sure that the model is robust. So we're going to go through this notice and comment process and come up with a really robust model. They came up with, it seemed like a really robust model. But then partly because they'd gone through this notice and comment process, it was really, really difficult for them to update or change that model. So again, it became overly static over time. And when it became overly static, you ended up with a situation where they failed miserably. OFEO no longer exists, and it no longer should exist. So I don't think that's like the right direction to go. So I think when we're thinking about like what are the mechanisms
Endgame
of
looks like
engagement,
gold,
there's
man.
a lot of really
Endgame
smart
looks
people
like
in this
gold.
room who are also incredibly knowledgeable, others watching online, figuring out whether it's a conference or other settings, how can we promote frank dialogue and learning? I think it's a
Removing the
really important
dependence of
end.
the
But I think
dollar
you want to be really mindful
from all the
of,
other
are you
countries
doing
around
this
the
in a
world.
way that continues to enable dynamism.
Starts in
and learning?
Switzerland.
I think one of the themes that came out of this morning's conversation
I'm wearing a tinfoil hat
is that
today. What
oftentimes
can I
there's
say?
problems,
It's-
things are overly static.
may look like a
and they're
bucket
not
hat, but
changing.
it's
So we want to
tin.
make sure we're not doing it in a way that introduces unnecessary or counterproductive rigidity into the system.
So, John, you obviously advise and sort of analyze U.S. investors.
I just want to pause it real quick. I also don't know about copyright rules, how long I can go concurrently with playing the same clip someone else is playing. But I just want to kind of go through what she just said. She said there's risk in transparency, and that the government has at no other time in history seen less trust really from people like you and I. And let me see right there. So what she's saying is that there's this risk that the system could be gamed by the big institutional banks and people that are trying to one-up us or stay ahead of the game by being more transparent, like on a day-to-day basis of things going on within the Fed, CPI indexes, inflation data, things of that nature that their 24,000 person staff, I'm sure their 5,000 economists get to see. It's quite often the case where the argument for any form of us seeing how the sausage is made is that someone's going to just trick you. Someone's going to get it over on you. And I don't know if I fully agree with that topic, or at least the side that she would take on it. I think there's absolutely ways that involve transparency, but we're talking about the systemic shifts of how we've seen our world work for decades and now centuries. So I don't know if those changes are coming, and that they probably anticipate more of the same. So probably that rigidness around where we're at.
The Basel standard allows for exempting reserves in certain situations. Both of those have some advantages and disadvantages. You're picking winners and losers between low RWA type activities, which can cause some market distortions. You could bucket all low RWA activity together and exempt that as a group, but that could hollow out the rules, so you might need to change the requirements. There's different things to do there. You do a countercyclical buffer, or just wait for the next crisis. Generally, I would say
That was
the market doesn't like
casual, just wait for the
uncertainty,
next crisis.
And generally, I would say it's maybe not great policy to be working on emergency measures. So to the extent that that path could be explained in advance, the market could discount it in advance, and I think it would lead to better market functioning.
How about some more views? What about this countercyclical approach? Should the agencies keep something in their back pocket ready to bring out during a crisis, or should they try to fix it once and for all? Anyone have a view on that? Tiffany.
Thanks, Daryl. I agree with Brian, and clarity and having the certainty in regulations is important, particularly as we're managing our balance sheets at banks. We talk about looking at various different scenarios and preparing for a range of outcomes. In those scenarios, we're typically not assuming that there will be any change in regulatory requirements. And banks may take action, reduce activity in advance of a stress, expecting no changes. So the structural permanent changes, the advance notice of that, helps steer and incentivize the right behaviors in advance of a stress, and then reduces the need to make any ad hoc changes during a stress period.
Don?
So I've been a fan of the countercyclical capital buffer applied across capital regimes, risk-based and leverage. We applied it at the Bank of England. Actually, I can't remember whether it was applied to leverage ratio. I'm looking over at Phil. It was applied to leverage ratio. I think a key, and I've advocated it and been rejected by the Federal Reserve many times. It's a familiar position, but I think the key is it's not just a one-way street that you have something you reduce in hard times. You have to make sure it's adequate in the good times, that you've got the capital high enough that if you release capital in bad times, leverage or risk-based, that the banking system is still safe. So counter-cyclical in both directions.
It's like they've been playing this cat and mouse game since 2008 when we started buying up
I'm going to
bonds.
move on and ask Ben a question.
Between collapse and
Ben,
cruising.
The Federal Reserve Board staff has estimated a $210 billion decline of capital at the GSIB depository institutions, but does that matter for financial stability given the much smaller $13 billion projected decline in capital at the GSIB holding companies? What are your views on that?
Thank you very much. It's great to be here today with everyone. When considered in the context of the broader large bank prudential framework, I think the financial stability implications of the difference are potentially positive. This is particularly the case in light of the GSIB resolution planning framework and the GSIB single point of entry resolution strategy, as well as the design of other Dodd-Frank Act enhanced prudential standards which focus on the holding company. The risk-based requirements are higher for the holding company than the bank, as you mentioned. And this reflects the fact that the GSIB surcharge and the SCB applied only at the holding company level. That, in turn, is itself illustrative of a key structural feature of the current large bank prudential framework, and that's a focus on the holding company. This is codified in Section 165 of the Dodd-Frank Act.
Speaking an enchantment
Many hallmarks
table.
of the current large bank prudential framework are all holding company standards. Some examples would include supervisory stress testing, CCAR, and then the stress capital buffer, internal liquidity stress testing, TLAC requirements for GSIBs.
It sounds like he's reading the terms and
then
conditions.
the joint FDIC and Federal Reserve resolution planning requirements. The proposal explains that it would do three main things. First, restore the ESLR to a backstop. Second, address the level and marginal regulatory incentives regarding low risk, low return, and higher risk activities. And third, provide the GSIBs more flexibility in the allocation of capital among their subsidiaries. I think the proposal would actually do three things beyond that. First, it would address the arguably anomalous role of the 6% bank ESLR requirement in the current prudential framework.
Poll
That's
is
a bank-level
posted. Poll
capital
got posted a
requirement
few minutes ago.
that's calibrated to be higher than for the holding company, but based on the GSIB status of the parent. It's actually the exact opposite structure of the GSIB surcharge itself, which of course applies only to the holding company. Second, there would be more consistency in the overall design of prudential standards with a focus on the holding company. And third, there'd be more alignment with the resolution planning framework, and in particular the GSIB SPOE resolution strategy. Under that strategy, in the event of failure, only the top-tier holding company would enter insolvency proceedings. The subsidiaries would be resolved without entering into their own separate proceedings. That strategy depends on flexibility, specifically flexibility for the GSIB to provide capital and liquidity to the subsidiaries based on their needs and resolution from centrally available resources. The strategy, of course, also depends to some degree on pre-positioning, which entails having some capital and liquidity already at the subsidiary level. It's a balance between the two. So the proposal would therefore have greater consistency with the structural focus on the holding company. There'd be more alignment with the resolution strategy for GSIBs. And from that perspective, there'd be the perspective to potentially have reduced fragility and stress, promotion of the resolvability of GSIBs, and therefore positive financial stability implications.
Thanks very much, Ben. What about other reactions? Is the fact that the dollars of reduced capital at the holding company is small relative to the depository institution, is that important? Is there sufficient flexibility in capital in the structure of a bank holding company and its subsidiaries? What are your views? Hal, do you have a thought on this? Do you have a thought on this, Hal?
Yeah, so as you said, Daryl, the reduction of the depository level was much higher than the reduction at the holding company level.
Come on, Hal.
But I think we need to keep in mind the basic framework in which the holding company of a bank has to serve as a source of strength for the bank's subsidiaries. So even though you are reducing the capital level of the depository institution subsidiaries, you have the holding company still with this obligation to support the subsidiaries. So I'm not that concerned because the holding company capital is not being reduced by very much at all.
Yeah, but it's not being added to.
So I agree. The fact that the holding company capital is basically unchanged is reassuring. I do wonder about the source of strength thing, though, Hal. I mean, once the capital is upstream from the depository to the holding company, downstream to the broker-dealer, or if it's not downstream to the broker-dealer, it won't do any good, right? So presumably the intent of the authorities is to have it downstream to the broker-dealer. Then you have a crisis. You have something happens that no one's anticipated. Are they really going to take the capital back from the broker-dealer and give it to the depository institution? In 2008, the board was asked to vote several times on exemptions to upstream capital from the bank to the holding company to support the broker-dealer. So I think we need to think more carefully
XRP.
whether the holding company would be actually a source of strength in a crisis situation.
Tiffany.
I think that all folds together to the fact that each bank is managing to multiple risk measures, capital being one, but liquidity, interest rate risk, and other measures will also support both the IDI as well as the holding company. So all of those various constraints ultimately
And the bond market looks
inform
weird.
how much could potentially be upstream
Has a lot to do with
not. So
interest
there are
rates.
additional constraints as part of a holistic risk
Everything.
framework that we are thinking of as well.
Thank you, Brian.
Yeah, I would just add,
I think 20 years above 5%.
to Ben's point,
have to look that
the
up.
resolution framework for a single point of entry is meant to capture sufficient liquidity and capital at the intermediate holding company to avoid the situation that Don is talking about. Can it effectively do that? It's not clear. Disclosure's not great in that area. So another area where it might be helpful to have more robust discussions around that to give more confidence to more participants that actually could work.
And that's about resolution. So you're in a situation where you're managing a failure. So it would be nice to prevent the failure in the first place.
There we go. We're not casually talking about crisis.
Ben, did you have a remark on that?
My only observation is I did refer to reducing fragility, and that's part of the benefit of potentially having greater flexibility. I mean, implicit in that reference to fragility is the possibility that the point of non-viability is higher
Slow
in 2019
down,
than it was
Dexter.
in 2008. So that's, again, a reason why I think it's beneficial to consider the capital framework alongside the resolution framework.
Benjamin Weiner. Benjamin Weiner.
Very complex topic. Don, I want to turn last
What
to
a
you.
name.
And you have been an advocate for reducing the SLR in order to make sure that it remains a backstop, as we've discussed, and doesn't impede the willingness of dealers to make markets in treasuries, as we've also discussed. But you've also noted an important caveat, that any adjustment does not reduce resiliency of the
CBDC
banking
would be
system.
deadly.
So when you look at the agency's proposals, how does it stack up against these criteria that you have in mind?
Thank you, Darrell, and thank you for inviting me to be part of this panel to the Vice Chair. So you're right, I've long supported enhancing Treasury market liquidity by making the leverage, the SLR, a backstop. In fact, a senior Federal Reserve official told me a couple of years ago I was using too much of my brain space on the leverage ratio. So I'm grateful to have that space freed up for something else. But as you noted, my support has been couched in the context that it not reduce overall capital requirements and resiliency. And I think I take quite a bit of comfort from the fact that there's no reduction in the on the holding company level. But I do think, as I just noted, there are things we need to think about. And I still have a few concerns on this overall resiliency issue I'd like to surface, and I hope come up in agencies' consideration.
Speak your mind,
First,
man.
obviously,
Speak your mind.
making the SLR a backstop puts extra pressure on sound risk-based capital requirements. And I think financial sector resilience is especially important right now. The economy could well be on track for good growth and low inflation. That's what's priced into financial markets. But we shouldn't be lured into complacency. Secretary Bessent last night worried about pro-cyclicality in financial markets. He cited private credit in that regard. But we know banks and bank regulators, from history we know banks and bank regulators are not immune to this particular disease. And the tails of the distributions around the central tendency seem unusually fat, as we are in uncharted waters with respect to the evolution of the global trading system, the ratio of federal debt to national income, and challenges to the independence of the Fed. So I think the risk of unanticipated developments are particularly high right now.
Talk on
And
it,
it would
Donald.
be preferable to evaluate this proposal as part of a holistic review of all capital requirements. In that respect, this is a terrific conference putting all this together. There's so many in the risk-based capital. There's the Basel III Endgame, GSIB requirements, and the stress tests, and how are they all going to fit into this? So were risk-based capital requirements the first line of defense weakened, I'd need to rethink my support for reducing the backstop, and I urge the agencies to put the whole package together before signing off and in one piece. And the second point, I want to come back to something
Man wants
that
to
came
prevent
up
crisis.
before,
I
and
like
that
it.
is, releasing capital at the DI will not reduce the resilience of the overall organization, but you will be encouraging. In fact, one of the benefits cited in the thing is encouraging banks to buy Treasury securities, so it does expose them to added interest rate risk, widespread losses on Treasury and agency securities contribute not only SVB's problems, but the risk to the broader system that triggered extraordinary actions by the authorities in March of 23. So banks should be required to mark securities in the available for sale portfolio to market, and the available for sale portfolios should be subject to market risk capital requirements. Bank interest rate risk management, even for the hold to maturity portfolio, should be subject to close scrutiny. And as I noted, my concern about interest rate risk would make me very reluctant, would make me opposed to exempting all treasuries from the leverage ratio. Thank you.
So the gist
I
of
wanna
your
grab a
remark
drink
is
with
that
these
you want to
guys.
see the whole package before a final view on it.
Yes.
Yeah, interesting. And other, Hal, what's your view on this?
So I think we need to keep in mind
back to the other
that
guy.
the U.S. banking system is today very well capitalized. U.S. GSIB actual capital levels have increased 17% over the past 2 years, and our minimum capital requirements are now 1.7 times higher than the Basel requirements. 837 billion
5%?
versus 473 billion under Basel because of our stress testing regime and gold plating. Keep in mind that we gold plate the Basel requirements.
Into the mic.
This proposal does not reduce risk-based capital. It merely moves leverage into the background where it always has belonged, and in my view, we could do away with, okay?
How's
And if
it
it's in the
needed?
background, you can further say, why do we need it then if it's now in the background? It's not binding anybody. Okay, so anyway, I think overall the U.S. banking system is in a very good place today in terms of its actual capital levels.
Hal got a little emotional there.
Hal, you mentioned gold plating. I'd like to get a reaction to something that came up, another topic that came up at dinner last night, which is the implications of the SLR and other regulations on the ability of U.S. banks to compete both with non-bank financial institutions and with international banking institutions. First, is that competitive angle, does it figure in your minds as an important aspect of the rule change? And secondly, is it actually true that U.S. banks have been at or GSIBs have been at a competitive disadvantage because of the capital requirements that we've been discussing?
Gerald, quite frankly, don't know the answer to that, but I would be skeptical. I think there are a lot of other factors that affect competitiveness. I mean, you know, when we originally adopted Basel, it was because of competitiveness concerns with the Japanese banks, right? And we said, well, get them on an even playing level, they'll have to have the same capital level.
New poll.
But then it turns out they have different accounting systems, they have different government subsidies, they have different forms of regulation, they have nothing to do with capital. So you have to add all of that into the picture when you're thinking about competitiveness.
Any other reactions on competitiveness?
Fire back.
Ryan?
I would just say, certainly, we have a higher SLR requirement than other jurisdictions, although that does not seem to have stopped our banks from competing very well against a lot of the international banks. I think certainly non-bank financials have significantly increased their scale and scope in some of these businesses, and they're obviously they don't have the same regulation, so that might have merit.
Yeah. And moderators don't get to vent their own views, but it does seem like better capitalized banks are better able to compete in principle.
Yeah, that was the point I was going to make. I don't think the UK, European, Japanese banks would think that they're at an advantage because their capital hasn't been gold-plated. I think the U.S. banks are pretty much competing very, very well in the international field. And there are times when being well capitalized, having high capital is to your advantage because, of course, under stress, there's much less to worry about. We saw that in the U.S. in the March 23 situation where deposits fled from regional banks where people were concerned about the embedded losses on treasuries and other things, and they fled to the GSIBs. And some of the commentary, well, that's because the GSIBs are too big to fail. But I think it was also because the GSIBs were much better capitalized and much, much less likely to fail.
Okay.
I'll make one observation, which
Yes,
is
go
that
ahead, Ben.
you receive a lot of questions about the regulatory capital or liquidity treatment about particular transactions or products and things of that nature. And that does clearly illustrate that they're marginal incentives and essentially what the marginal capital cost, liquidity cost does factor in. That's not necessarily contradictory, but I think it does show that that actual marginal effects of regulation do factor into business decisions. And there are differences between U.S. and non-U.S. requirements.
Tiffany, at a global bank.
Well, I was going to re-highlight some of Don's points. One being completely support interest rate risk management. It's a strong pillar. It's an important risk pillar. And as I mentioned, it's an important part of the overall risk management framework for banks. Second, the holistic review, I think, is an important point as well, because we find that, again, managing to a lot of risk measures, making a change to one risk measure is likely going to have another become binding over time and could have the same constraints, let's say, on the treasury market. So I think that holistic review is also makes a lot of sense.
And that would require QE.
Terrific. Okay, I think we got a pretty good sense of the views of the panel, and I think it's time to turn to you all. If you have a question, would you raise a hand? I see there are microphones. Would you also please identify yourself?
Ask
and,
something good.
Try to keep it to a question, just one.
Use the mic
we have a
wisely.
second round, we can come back. And not a speech, just a question, please.
Is this my name is Guowei Zhang. I'm with SIFMA. My question is, as you know, currently Category 1, 2, 3 banks are subject to 2 leverage ratios. One is supplementary leverage ratio. The other one is Tier 1 leverage ratio. And the question is, why do you think 2 ratios, both target leverage, are needed for these banks?
That's fair.
Okay, I'm going to ask anyone that can address that question, because I don't want to handle that one. Hal, do you have a thought on that?
I'm not going to defend one of 2 ratios when I disagree with both of them.
He's a jokester.
I'm watching for hands.
Did he not get an answer?
Yes.
That's lame.
Hi, Sharon Ishai from Morgan Stanley. I actually have a question directly to Don. You mentioned that you think that we should have a countercyclical buffer. You mentioned overlap between different parts of the capital regime. You mentioned that it was something that made sense in the UK, but at the same time, the US has a much different capital regime, inclusive of the CCAR test, for example, which does give you an ability to build capital to be there for stress. And so I'm curious as to why you would want to impair potential use of capital from the banking institutions in a period of stress where they could be using it to lend and still put on an additional countercyclical buffer on top of that.
Yeah, but the rates are too high for anyone to want to lend.
The
lendee.
concept behind having overlap is not necessarily taken into account from a buffer mentality where you don't necessarily have the CCAR exam in the UK.
Put it in front of your face.
So I certainly think there's simplification and the 2 leverage ratios and overlap between things. That's why this is such a great event today, because the authorities can hear views about how these things interact and whatnot. But I do think my countercyclical buffer thought, or at least the way we exercised it in the UK, was exactly to free up capital in a stress event. And by lowering by taking out the countercyclical part, you enabled banks to use that capital without running into restrictions on dividends and buybacks and that kind of thing. So our view, and
We'd hate to restrict stock buybacks.
As I've read the studies that came out of the March 2020 COVID thing, that for countries in Europe that had countercyclical buffers, they found that the ones that released those buffers had better lending experiences than the ones that didn't. So maybe I didn't understand quite your question totally, but the whole point of the countercyclical buffer is to encourage lending in stress situations, or discourage having a constriction of credit add to a stress situation.
Alistair. Oh, sorry. Yes, you. Thank you.
Bill Demchak. I'm
Sorry,
the
Bill,
CEO of
pardon me.
PNC. Just an observation. This entire conversation on leverage ratio and then pointing to the functioning of the treasury market. What we're actually talking about is the ability of prime brokers to increase their balance sheet in times of stress. So the noise around, hey, banks are just going to go buy more themselves up because they can take more interest rate. We're not going to buy any more treasuries. We can get duration 100 different ways without going to the treasury market. We can do it off balance sheet through swaps. What we're simply talking about is it a good idea to give GSIBs the ability to grow their prime brokerage operation to support the actual capital providers into the treasury market today, which are principally hedge funds. And by the way, I am in favor of that, but I would reduce the conversation to that because I think our issue ultimately becomes the size of prime brokerage across Wall Street as opposed to what the leverage ratio is.
So Bill, would the support for hedge funds and others through prime brokerage increase in a stress? So I think one risk, isn't it, that this actually enables the hedge funds to become more levered because banks, and now you've got a stress hits and the margins start increasing and the pressure on the hedge funds, the basis trade blows up even worse.
You're picking your poison, but that is the correct discussion. So banks, since I worked on a primary dealer desk 30 years ago, they don't take down the auctions anymore, right? We used to, we no longer. The hedge funds bid the auctions, the big banks finance the auctions. If you get an off-the-run treasury that won't trade because it's unfinanceable, you get disruption and dislocation. So you want to be able to finance it. You say, all right, well, I want the treasury market to function because we're running the biggest deficit we ever had, and it's likely to grow, so therefore I need to get capacity to make this thing work. I need to expand the prime brokerage, central clearing, a whole bunch of other things to allow that to happen, all of which I'm in favor for. But I'm simply saying that we're consciously choosing to ask banks to finance a larger portion of the principal positions of the players in the treasury markets. That's what this rule is about.
Yes, Pete, a question right here.
I have a follow-up actually to Bill's observation.
Could you give your name?
Peter Blaustein, PB Investment Partners. So a follow-up to Bill's question is perhaps heretical, which is to ask, are there other rules that should be addressed if we're trying to get more treasury market liquidity, namely proprietary trading and the Volcker rule? Should banks rebuild relative value fixed income desks that all migrated out of the banks post-Dodd-Frank, post-Volcker, and that should be the place for treasury market intermediation rather than hedge funds as Bill suggests? Just an off-the-run thought. Thank you. I'm curious if any panelists support that view.
Any views, panelists?
Well, I think in the context of looking at and taking a look at regulations overall, it's an important
what this type of new paradigms mean for financial stability and for growth ultimately. And specifically, so we did last year a new kind of stress test, which was our system-wide exploratory scenario. We love talking about it, so I'll be very brief about that. Where we basically stress testing an entire market, an entire ecosystem, and core UK markets, so the gilt market, the gilt repo market, and associated derivatives, with many participants beyond bank, including hedge funds, asset managers, etc. And to understand first how resilient the markets would be to the shock, and second, how the behaviors of the participants could amplify that initial shocks, and what that meant for how those participants should adjust their playbooks so that if one of those shocks does happen in the future, they're better prepared for it. So the answer is not more capital, more liquidity, is just being better prepared when those shocks happen. And some of those shocks have happened, even very recently. So it is very helpful, and the benefit of that, we saw some of that in the recent turbulence. So those system-wide exercises have a bright future in our mind in the UK. But even just for banks, and coming back to exploratory scenarios, just for banks, for the banking sector, these have been very helpful. And for example, when the pandemic hit, we ran a desk-based stress test on the scenario that our monetary policy committee had published, an illustrative scenario about how the stress could evolve through and propagate through the economy. And we wanted to know something very simple, which is, well, how would the banking sector react to that shock, to that scenario? So we did it, we ran it, desk-based, and we got the answer that they could withstand the shock and continue to support the economy in those conditions. A few months later, in August, we ran a reverse stress test because we wanted to know, the scenario had started to unfold, and we wanted to know how bad it would have to get for banks to start to be constrained in how much lending they could do to the real economy. What would it take for banks to run down their buffers? We talked about the usable buffers. The reverse stress test told us that. And both of those things meant that we could say, when we ran those tests, we could say to banks and in our public communications during that period in the start of the pandemic, that we expected banks to continue to lend to the economy. That was one of our big messages at the time, because they were strong enough to do it, and because there was one of the key roles they had to fulfill in those circumstances. That was one of the uses of those exploratory scenario. Last year, we ran another desk-based stress test of the banks at a time where there was great global uncertainty. And it was very difficult to anticipate where things would go. You can still say the same now. And we ran it, we talked about running multiple scenarios before. Well, that's what we did. We ran two scenarios, a supply shocks and a demand shock. One with interest rates going up, the other one, interest rates going down. So we did not have to guess which one was the most relevant or the most usable. We ran both using our desk-based toolkit. And that was very helpful thing to do. And it informed indeed what type of scenario we are using this year for our full-blown bank capital stress test, for example. So those are the type of things which don't necessarily lead to capital, but they help us answer a much broader set of questions and help the markets more generally being better prepared. So let me pause here. All these things are in our mind, they have a great future. And we feel that's an important direction towards which to point our toolkit. But what's for sure is that that's here to come, and especially is as memories from the global financial crisis are fading, because stresses do keep happening.
Thanks a lot. So we're going to open up for questions. I'm hope that the CFO panel will actually address one thing we don't have time, which is we can see the benefits. We've certainly talked about the benefits of exploratory scenarios, but what are the costs to the banks if we're doing exploratory scenarios? Yeah, so I think we've got a question here in the front. Sharon.
Hi, Sharon from Morgan Stanley. Till, I had a question directly about something you said that I didn't fully understand. So I actually agree. I think there's a great benefit to using some of the bank's own models within, working with the Fed to help them understand both where we come from an industry perspective, changes. I think a lot of the bank models right now are done on an industry level, particularly when you think about expenses, for example. And that, I think, does create a lot of challenges with the underlying results that you end up seeing from a stress test. But you said something where you agree with that in peacetime, but then in periods of stress, you would use the bank's models. Now, as we know and we saw in COVID, you have periods of stress that are pretty immediate. How would you move to the Fed models so quickly, and how would you make sure that you're holding enough capital? I didn't quite follow how that would work.
Right, so just to be clear, I think in a crisis, I would err towards using just the supervisory models, or mostly the supervisory models.
But how would you go back? I guess
right,
how would you flex?
Right, so a key question there is, and this is always whenever you have these discussions of peacetime versus wartime as well, when do you know that you're in wartime? Yeah, so I'm going to punt on the question of when do you know when you're in wartime, because it's an admittedly very difficult thing to decide. But you could also make that gradual, so that if you're not quite sure, but you think that it's on the horizon or it's on the threshold, or you might in fact be in it, then this blending approach will allow you to shift gradually more and more weight towards the supervisory model if you're not quite sure. And if then there comes a point where you're quite sure, I mean, in late 2008, we were pretty sure we were in one.
I was just more thinking of
Right.
COVID, right? You one day woke up and there was a global pandemic. You weren't really that sure. It took 2 weeks and all of a sudden we were all at home. So it was a little.
Right, but 2 weeks is pretty fast.
Yes, that's my. Okay. Thank you.
Back there in the middle, in the back. Yep.
Hi, Luigi DeGenghi from Davis Polk, AKA one of Randy's former partners. This is a question really almost more, it's directed to the panel, but more directed to Mr. Benjamin in particular, which is if you're going to try to create a balance between reliance on bank models and supervisory models, how do you strike that balance? Or to put it another way, will you do it based on a particular percentage variance between the results of the models? So you say, okay, I'm going to rely on banks' models up until they vary up to a certain percentage from the supervisory results, then I'll question them. Or is it based on supervisory feedback and discretion, which obviously is less transparent?
So just to be clear, our starting point is to use the models that banks, so the estimates that banks submit to us. Typically what we see is that in the aggregate, basically both type of approaches agree and point to the same answer. We've never really had any issue on that front. Where there's more variation is firm by firm, bank by bank. So when there is a variation between what our models say and what the bank's models say, we ask why. And we have that conversation bilaterally, privately with the bank. And sometimes there's a good reason for it, maybe better risk capture or something else. And sometimes there isn't. And in that case, then that leads to an adjustment. But it's a conversation, a private conversation we have with the firm. One example, for example, and we talked about the difficulties of modeling net interest income, which you called PPNR, I think, here, is what assumptions do you make about pass-through of the rates that are paid on deposits, for example? And you can have different firms making very different assumptions, and because we see what everyone submits, we can say that, in a world where there's competition for deposits, not everyone can be right at the same time. So that's an example of an adjustment we would make to a firm's estimate. So that's how we've been running it for a long time now.
Got one back here, and then
So
Daryl
no to the
Duffy.
variance.
Sorry.
Supervisory.
Looking at me. I was just going to pile on the PPNR issue. I think the notion of going back and forth between bank models and Fed models doesn't work no matter how you weigh them unless we get the Fed models right. I think you'll find universal agreement amongst the banks that the PPNR approach that the Fed takes, it's one of the reasons we've all screamed, is just wrong.
There's
so
Jerome.
I want to be really careful about some assumption that, hey, we can use ours sometime and then just jump back to a bad model. The whole exercise on having transparency with the Fed models is to hopefully be able to, put eyes on whatever is causing the variance that we see every year when we do this. Severe enough, just as an aside, our firm, for example, right, we always try to solve an outcome worse than whatever the Fed's going to come up with, and the only way we can ever do that is just bin a giant operational loss into our results.
Frying them.
Because we don't have any idea what the Fed model's doing. The second point I would make that I do think is really important, and I think the UK gets this right, is some risk measure stress around interest rate risk in the banking book. We have no measurement today in the US that looks at this, and we need to. And then the final thing I would just remind everybody, to me, the stress test, we do multiple stress tests continuously. The stress test shouldn't just be about a pretty bad thing that we can all survive. It should actually it should be about the thing none of us can survive. When you run a risk book, you always figure out, that's what you do all day long, is what's the thing that can get me fired? What's the thing that blows me up? And there's always something, right? There's always a weakness in the system. And so in the scenario design, not that I want to publish and scare everybody, but I would actually spend time in the scenario design and the what if, these alternative scenarios, to what is the worst case that we can come up with. And you can, I can come up with a lot that would scare, scare the heck out of us. I won't plan to that scenario, but it's good to know what that is.
Yeah.
Could you just pass the microphone over to your right, and then if we have time, then Harold Duffy next.
Stagflation.
Yeah, no, right there, yes.
Yeah,
you.
Bond
And
market
then-
decimation.
Quick question. Scenarios, models, exploratory scenarios, there's a lot of potential cost here, and I think you were going to raise this issue. My question is whether this activity, stress testing or process, lends itself to efficiency gains, perhaps substantial resource cost reductions via artificial
You're
intelligence.
right, V. Oh my God, is that a skeleton?
Anybody want to answer that? Was
Who
there
was
a
that,
question?
Father
No,
Time?
Okay. Daryl, do you want to ask?
Sam Altman
Last
left the
question,
room.
sorry. Okay.
Great. There's been quite a bit on the costs
was
and
at the
benefits
Jekyll
of
Island
multiple
meeting.
scenarios, among which you already mentioned volatility of capital requirements on the one hand. Several of you mentioned benefits of getting more information about different types of stresses, but none of you have discussed it. I noticed the extent to which a bank may have an incentive, if there's only one scenario, to adjust its business model and its balance sheet towards that one scenario. Is that a significant risk, especially when the tests
What's
are quite
insinuating?
transparent? Or do you have the opportunity to change that one scenario often enough that banks would not have time to all tune themselves to that one scenario with the attendant risks?
Talking about crypto?
Okay, John, then Till. Yeah.
Go ahead, Till. I know there's six. There are 6
Gold?
bank CFOs coming up next who'd probably really answer that question well.
Yeah, so I do think there is a risk of this. I think the risk
Lock
is
it
not so
in.
much that you do it from one year to the next. I think the risk is more that for some, I mean, really, if you look at the DFAST program since almost its inception, the shape of those scenarios has not changed much at all. Many of the sort of core variables, core stress factors, the basic shape has changed like literally almost not at all for GDP and unemployment and house price indices and so on. So over time, you're kind of teaching the industry to just focus on these tests, these scenarios. Everything is just pegged to this one scenario. So over time, it's very natural for banks to respond in kind, because keep in mind that all a stress test is a very, very bespoke risk weighting algorithm. It's not really anything different. And so if we think that banks will respond, either desirably or undesirably to a particular risk-based capital regime with particular risk weights, we shouldn't be surprised that also they will respond similarly if the same scenario, more or less, over and over and over is presented to the banks, and they'll shift their business model.
Okay, go ahead.
If I may. So
Talking about capital
I agree with the
requirements.
sentiment behind your question, Darrell, about the merits of being able to run several scenarios. That's why last year we did that with our desk-based capability. So this was not a full-blown capital stress test, setting capital requirements, requiring submissions from firms, but we use our own models, our own technology to do that, and we got a lot out of it. And that's then linked to the next stress test, which did set capital. So that's a bit of a halfway house to get to your point. In terms of efficiency, I very much agree with the point on efficiency, but the fact of moving to every second year instead of every year on a full-blown capital stress test, does mean a considerable reduction in burden and in resources spent on those capital stress tests.
Which you could use toward testing the other things you
capacity
said.
that gets freed up by that, we very much expect that will be used by banks to improve their own risk management for that. But there has been a big reduction as a result of that.
Okay, thanks a lot to our panel. Very interesting. Thank you very much.
Are we all done? Are we concluding the event? Are we all done? We'll see. Looks like people are cleaning up their spots. Oh, nope, break. Just a break. Maybe after this, we get Jerome. Maybe. Maybe I'm just hopeful. I did think there were some good questions there around, are we testing the scenarios of those doomsdays? What if the stock market were to do X while the bond market was inverted? What if the yield curve that is typically a signal of pain in the future actually goes back under again? What if God, the Fed chair resigned and it sent the bond market into a fury? Like there's a lot that could be talked about, and I think the main sentiment around those last few questions were, are we softballing our tests, our stress tests that we're running, these data-led studies that we're running that obviously Bank of England guy was talking about there being too much money to conduct more. Are they too softball? Are they too minor league? Stagflation's a great example. I've seen Jerome Powell fumble multiple times on what stagflation would result in Fed Reserve Board and FOMC decision-wise, what they would do with rates, what they would do with monetary policy, would they get back into QE? And he's waffled the question quite a few times to the point where you're like, have you guys talked about this? Or are we running scenarios to say, okay, if X and Y were to happen, if inflation were to continue to go up, all while wages stay stagnant, economic activity stay stagnant, housing market, all these things stay stagnant? Like, are we running that very likely, I think at this point, like doomsday-ish scenario where the Fed may lose control over the Fed rate because the bond market's not responding to their levers anymore? So I like those questions. I do. I think they're noteworthy, and I like that the one guy was getting a little heated. But I'm gonna go grab a drink. I'm gonna go hug my wife. We're gonna stay on. I'm gonna let the music lull into the background as we await the end of the break. on break. What's going on? Jesse nailed it. And the brink. Bring J. Powell on stage, baby. That's who the people want to see. Bring Jerome. Tomatoes so good. That was a garden fresh tomato right there. Oh, it was good. Mixed with the beautiful, luxurious chemicals of Alani Blue Slush. The combination will be legendary.
Day.
Oh.
My name's Adam Gilbert, partner at PwC.
No, Jerome.
I'd like to thank Vice Chair Bowman for putting on this very important conference.
All right, guys.
And inviting
No
me to
Jerome's a
moderate
no from me.
and pulling together this
That'll be the end of the
outstanding
stream.
panel. Let me
This
introduce
is our last
them
panel.
quickly. Daryl Bible to my left.
Let's see what they're talking
M&T Bank, Alistair Borthwick from B of A, Rahul Nalgokar from BMO, John Stern from US Bank, Mike Verdeshi from Charles Schwab, and our anchor, Sharon Yeshaya from Morgan Stanley. So thank you to all of you for joining us and for this terrific panel. It's fitting that we close the day with perspectives from CFOs. The CFOs play such an important role in the capital process at banks. In fact, they own or manage with their teams the capital calculation, the allocation of capital in the bank, the capital action planning process, the communication with investors about those capital actions, and importantly for this forum, play a leading role in policy discussions. So it's really appropriate that we conclude the day with perspectives from the CFOs. So I'd like to start by asking for your perspectives on why reforms to the capital framework are so important at this time. Does the current framework cause you to make suboptimal or inefficient decisions? Are there competitive issues that are especially problematic because of the framework? For example, have the capital requirements played a role in pushing assets outside of the regulated banking system? We've heard about that, some of that today. So Mike, would you kindly lead us off on this framework setting question?
Which asset?
Yes, thank you, Adam. And again, on behalf of the panel, thank you, Vice Chair Bowman and the broader Federal Reserve. Important set of discussions today centered around ensuring safety and soundness, while at the same time ensuring the banking system can support growth in a range of environments. Taking a step back, so much of what is the capital regime today was born out of the experience of the crisis of 2008. Since then, the capital regime has evolved, but so has capabilities at firms and a broad range of capabilities managing
Jerome's in the
across
crowd right
regimes.
now, I think.
That is a really important element to think about,
We were
certainly
hoping to
as
see
they
him on a
connect.
panel. He had the opening remarks
Stepping
today.
back, yes, this is the right time for that holistic review. And really, we heard much of this today. 3 themes I would highlight. Think about that holistic view in terms of where are the best practices that resulted in the capital regime that we have today. Where within the capital regime do we have redundancy and therefore inefficiency? And then lastly, what parts of the capital regime have unintended consequences? And to unpack that a bit, some of those best practices we just heard from the stress testing conversation, those internal stress tests have been developing over time. And the banking system have gotten much better at them in terms of identifying emerging risks in the face of an evolving macro environment and understanding whether you have the capability to manage those risks in a range of environments. And importantly, tailored to one's business model and tailored to one's business strategy. So I think I continue to emphasize the use of internal stress tests, whether that's a complement, whether that's the primary. It's really important that internal stress tests are utilized. In terms of redundancy and inefficiency, again, we heard about the different elements of the framework, leverage, evolving risk-weighted assets, and then importantly, stressing risk-weighted assets. And do we have more capital through those mechanisms than what's needed?
Right at the end.
And does that in any way get in the way of providing that capital to the broader economy as needed? Importantly, as well, in the inefficiency, as we see environments unfold like we did in 2023, there were different elements that caused problems of certain banks, and that was the connectivity of liquidity and how that interacted with interest rate
SVB Bank,
risk.
Silicon
It's
Valley.
important that capital is relied on for the solution of all things. It's important as those environments unfold and there are certain vulnerabilities to ensure that the framework entails making sure you have the capabilities to manage those risk stripes and not just rely on capital. And so there, sound balance sheet management ensures that you can identify
All right,
risks,
I'm gonna call it.
measure
We're not getting
various
Jerome today.
risks,
We
and
wanted
ensure you have the
Jerome. We were
capabilities
promised
to manage
Jerome.
those risks in a range of outcomes.
We didn't get
That's
him.
capital, that's liquidity.
So
but
I'm
that's
going to go
also-
ahead and sign off. Appreciate everyone that's jumped on. Subscribe for more up-to-date news on what's going on in the economy, the House, the Senate, and the executive branch in a neutral fashion for the working class individual here in America. Appreciate you.